The price of crude oil has fallen dramatically over the last 6 months. On the 25th of July 2014, the value of a barrel of Brent crude oil was $106.34. The price of a barrel of oil on the 30th of January 2015 was $46.76. These figures tell us that the price of oil has fallen by 56.03% in just over half a year. A decrease in the price of a similar magnitude has not been observed since the financial crisis of 2008. Whereas the last time the great dip in price of oil was cause resultant of the activities leading up to the recession, the most recent reduction is the result of an economic strategy put into place by the Saudi Arabian government. The continued increase of fracking and output of oil in the US has put more and more pressure on Saudi Arabia to compete for sales in Asian markets. According to the International Energy Agency, the US was on track to overtake Saudi Arabia and become the dominant exporter of oil. In retaliation, Saudi Arabia has increased their oil production, reduce their exploitation costs to the east, and force the price of oil down. They will maintain the low price of oil for as long as they can, or until the government needs money once more. This is in an attempt to force the Russian and US production of oil to decrease. Smaller, less established fracking companies such as Diamondback run the risk of going under due to the reduced profit margins, and although larger companies such as Exxon won't go bankrupt, they will still suffer. This tactic, however, is not sustainable. Once the Saudi Arabian cash reserves run out, they will be forced to reduce production level and increase exploitation costs, and therefore this will eventually bring the price of oil back up. The current price of a barrel of Brent crude oil is $54.62. In order to predict the future price of oil at the end of 2015 and 2016, we have used a combination of linear regression using data from the past 6 months and the past 4 years, and then also forecasts from Goldman Sachs and JP Morgan. We have also looked at the actions of the Saudi Arabian government, the supply and demand of oil, and the historical pattern of change in oil price. For the 4-year oil price regression forecast, we have used data from the 30th of January 2010 until the 30th of January 2014. We were able to plot a regression line and determine its gradient. We would then use this to estimate the price of oil on the 31st of December 2015 and the 31st of December 2016. Our values were $108.13 and $110.16 respectively. The problem we found was the issue of validity. The spread of this data is very large, therefore the distance between many points and the line of best fit was great, which brings into the question the accuracy of these forecasts. For our half-year regression forecast, we did the same, except this time we used the last 6 months of pricing data. This gave us negative estimates of minus 88.4 for 2015 and minus 254.3 for 2016. This clearly isn't accurate, but just demonstrates how irregular the sudden dip in oil prices is. According to the reports of JP Morgan and Goldman Sachs, the forecast for the price of oil in 2015 and 16 will be $50.4 by the end of 2015 and $70.0 by 2016 for Goldman Sachs, and $49.0 and $56.08 respectively for JP Morgan. To give an estimate based on all 4 of these forecasts, we have assigned weights to each value based on our perceived reliability and validity of the source, and then we took the mean. We assigned weightings of 0.35 for the 4-year regression forecast, 0.05 for the half-year regression, and 0.3 and 0.3 for both Goldman Sachs and JP Morgan. Using this, we found initial values of $63.2 for 2015 and $63.6 for 2016. These values are just initial estimates and will be greatly affected by economic and political circumstances. The first circumstance that will have taken effect on these values is the longevity of the Saudi Arabian tactic. The Saudi Arabian government's budget for 2015 is equivalent to $229 billion. This is based on the assumption that the price of oil will remain at approximately $60. In 2013, 92% of Saudi Arabia's budget was funded by the exportation of oil. If we assume the same to be true for 2015, then exporting oil will bring in $210.68 billion. Saudi Arabia has also accumulated $450 billion in cash reserves. The price of a barrel of oil hovered around the $120 mark from 2012 to 2013 before the price started dipping halfway through 2014. The price of oil currently in February 2015 is fluctuating about the $60 a barrel mark. This suggests approximately a 50% reduction in the revenue from oil exportation. Taking all this information into account, exporting oil will only bring in $105.34 billion. In order to maintain the $229 billion budget, the other $105.34 billion will have to come from their stockpiled cash reserves. Based on all this information, we can calculate that Saudi Arabia has the capacity to maintain low oil prices for just over 4 years and 4 months, and this would use up all their cash reserves. Say Saudi Arabia decides to use only 30% of their reserves and keep the other 70% for an emergency, say in case of a war outbreak, then the price of oil could be kept low for just over a year and 3 months. This assumes that Saudi Arabia's budget will continue to be $229 billion for each year for the foreseeable future. The level of oil production is maintained and the price of oil stays at approximately 50% of what it was pre-crash. We must also take into account the supply and demand of oil.
The historical oil demand and supply balance graph show us that the world oil supply overcome oil demand since at the end of 2013, and now the gap between the supply and demand, which is the surplus, is even at the largest gap. However, as forecasted by the experts, by the end of 2015, the world liquid fuel demand will overcome the supply again, which would drive the price of oil down due to the relationship of supply and demand of oil. Therefore, the price of oil is likely to be stable or even lower in 2015. But according to the forecasting of the balance of world oil, the price will bounce back gradually from 2016. Also, if we look at the demand and supply balance between 2009 and 2012, when the demand of supply overcome the supply, the world oil price has increased by a large scale, which is increased from around $50 to $100. This could positively support our speculation.
Finally, if we look at the historical pattern of change for oil price, we can see that during the financial crisis of 2008, the Brent crude oil price plummeted from $133.05 to $41.58. It took over a year for the price to increase back up to $74.67. The oil price then peaks at $119.7 in February 2012. This took just over 2 years. According to the past pattern of change, and also according to the expert prediction that $50 is the floor of oil price from renowned forecaster Bill Connolly, we predict that the Brent oil price will continue to drop down a little further, and then it will slowly increase back up to a price in the region of $60 to $100. In 2 years' time, the price might even reach a new peak. According to our perceived influence of our qualitative sources, we estimate that the following factors will each influence the oil price respectively. Applying these percentage changes to our estimates gives us values of $60.14 for 2015 and $95.4 for 2016. Due to the vast amounts of uncertainty, we suggest that the value for 2015 could change by up to 15% of our estimate, and for 2016 by 20%. To summarise, we predict that by the 31st of December 2015, the price of a barrel of crude oil will lie somewhere in the region of $51.12 and $69.16. And by the 31st of December 2016, we predict that the price of oil may have risen significantly to somewhere between $76.32 and $114.48. When looking at the share price of Diamondback Energy, we calculated that the correlation between Diamondback Energy share prices and the price of crude oil over the last 6 months is 0.83. This suggests that the share price will closely follow the trend of the price of oil. First, we used RStudio to plot the share and oil prices from the 30th of June 2014. From the regression line, we can see that when the oil price decreased, the share price should have also decreased. What we can observe over the last 2 months, however, is that the share price has been increasing. The increased share price may be a result of the following external factors. Secondary common shares. On November the 12th, 2014, Diamondback announced that they would be offering secondary common shares. They started offering these shares on the 21st of January 2015, and through sales have been able to increase their company's assets and raise capital growth. The evidence for this is the increased share price of Diamondback Energy over the last 2 months. The appointment of a new board director. On December the 22nd, 2014, Viper Energy, the main subsidiary of Diamondback, appointed Miss Rosalind Redfern to the board of directors. Miss Redfern has extensive experience in the oil field and is renowned for her expertise. Redfern has an active role in over 5 oil-based companies and has had experience over 25 years in the industry. Her addition to the board will have increased investor confidence. High amount of reserves. The potential production capability of our company is positive due to the fact Diamondback have been acquiring new oil reserves. Diamondback have high reserves and will be able to maintain their level of oil production for the foreseeable future. Reduce competition. As the price of oil is driven down, some of the smaller oil supplying companies operating in the US, specifically in the Permian Basin, are likely to be able to cope and go bankrupt. If this is the case, then the reduced competition will benefit Diamondback. We then looked at a larger range of data from the 12th of September 2013, as around this time the share price was more stable. After plotting the regression line, we found the y-intercept to be 52.65 and the gradient to be 0.068. We were therefore able to estimate the share price at $98.31 by the end of 2015 and 123.47 by the end of 2016. Our final share price estimate takes into account 20% uncertainty for 2015 and 2016 and gives us 2015 estimate between $78.65 and $117.97. For 2016, our range is from $98.78 to $148.16. Number of barrels sold. We used the quarterly sales data from 2012 to plot a regression line. We then used this to estimate the number of units sold in each quarter of 2015 and 2016. After adding up the 4 quarters for each year, the data suggests that Diamondback will sell 6,895,955 barrels in 2015 and 9,026,638 barrels over 2016. We compared the estimated number of sales with Diamondback current reserves of oil and concluded that Diamondback has approximately 20 times as much oil in reserves as they would sell in 2015. This demonstrates that even if we do not have sufficient funds to continue exploration, we will be able to keep output consistent. Comparing Diamondback reserves with one of our competitors, Diamondback Energy, shows that our magnitude of reserves is competitive enough to serve the market. On the capacity side, there is no problem. The only issue is ensuring that we make sufficient profit per barrel in order to continue operations. The average cost of producing a barrel of oil from the Permian Basin is approximately $68. However, according to the Diamondback annual report from 2013, the average cost for Diamondback to produce a barrel of oil is $45. As long as the price of oil remains above this figure, we will continue making a profit. We suggest that the units sold by the end of 2015 would be a bit lower than our mean rate so far. For 2016, we believe that our sales would once again increase as the regression line forecasts. We have assigned uncertainty levels for 2015 and 2016 of 15% and 20% respectively, which means that our final estimate for the number of units sold lies in the following ranges. For 2015, we estimate between 5,861,562 and 7,930,348 barrels. For 2016, we predict between 7,221,310 barrels and 10,831,966 barrels.